Did you know that Miami's Lincoln Road is experiencing over $3 billion in luxury residential and hospitality investment? This thriving corridor is now home to a new Victoria's Secret flagship store, marking a significant milestone for the area. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Halmoon. Let's get right to it. Lingerie, clothing, and beauty retailer Victoria's Secret has signed a lease agreement with private fund ALTO Real Estate for a new flagship store location on Miami's Lincoln Road. Located at 900 Lincoln Road, the new store recently opened within 7,500 square feet of premium Miami retail space, for which the retailer signed a 12-year lease. ALTO invests strategically in properties that elevate our portfolio, and Lincoln Road exemplifies such an asset, said Yaniv Melamud, co-founder and chief executive officer of ALTO Real Estate Funds. This long-term lease with Victoria's Secret reinforces the value of this prime location and strengthens our presence on one of the most prestigious retail streets in the United States. ALTO Real Estate Fund acquired the property in 2021, banking on the Lincoln Road corridor's potential for resurgence and long-term growth. Coming on the heels of 6 months of extensive preparations, Victoria's Secret anchoring of the location represents a major milestone for both the retailer and Miami's vibrant shopping district. International investors and global brands alike are gravitating to the area, which is currently experiencing more than $3 billion in luxury residential and hospitality investment. Projects include the Shore Club Private Collection with ultra-luxury residences and penthouses, the Raleigh Hotel undergoing a full-scale $1 billion restoration, and a 48-story landmark tower dubbed Five Park that aims to deliver boutique hotel-style living and sweeping ocean views. Miami Beach is solidifying its reputation as a world-class destination for fashion, lifestyle, and long-term real estate value. As retail and office spaces tend to share success, we're also seeing strong performance in that sector of the local market. According to the most recent National Office Report, the full-service equivalent listing rate for office space here was roughly $57 per square foot in July. Additionally, more than 1.5 million square feet of new office space is under construction, and year-to-date office sales saw properties change hands for an average of nearly $260 per square foot. Winter Gardens Plant Street is on the brink of transformation with the groundbreaking of a new mixed-use development. This exciting project is set to infuse the area with both temporary and permanent job opportunities, contributing to the local economy in a substantial way. The Plant Street Commons, as the development is known, is expected to open its doors in late 2026, according to the Orlando Business Journal. Atrium Development Group is spearheading this project, aiming to enhance the vibrancy of Winter Gardens Plant Street. The development will not only offer residential spaces, but also include retail and office components, making it a comprehensive addition to the community. This initiative aligns with the broader trend of mixed-use developments, which are gaining traction across North America, offering integrated living and working environments that cater to modern lifestyles. The Plant Street Commons project reflects a growing interest in creating urban environments that support a mix of uses, which can lead to more sustainable community growth. This is particularly relevant in the context of Kitchener-Waterloo and Cambridge, Ontario, where similar projects have been undertaken to revitalize urban cores and support economic development. These areas have seen a rise in mixed-use developments that blend residential, commercial, and office spaces, providing diverse amenities and fostering community engagement. Looking at the American perspective, cities like Winter Garden are capitalizing on the benefits of mixed-use projects to attract businesses and residents alike. Such developments are pivotal in transforming urban landscapes, offering the convenience and accessibility that modern consumers and businesses demand. It is a trend that mirrors similar initiatives in Canadian cities, where integrated urban planning is becoming a key strategy for growth and sustainability. India's wealthy are increasingly favoring commercial real estate for its higher yields and stability compared to residential properties and debt instruments. Fueled by a growing high-net-worth individual population, their investments in commercial properties are also diversifying into warehousing, hospitality, and data centers. Alternative investment funds offer a streamlined entry, but due diligence remains crucial to navigate risks and ensure sustained returns in this evolving landscape, according to ET Bureau. Investing in full commercial real estate is largely out of reach for retail investors. The entry cost is high, and the due diligence required is complicated. In India's affluent hubs, from South Mumbai's glass towers to Delhi's leafy Lutyens bungalows, the wealthy are quietly rewriting their playbooks. Stocks may still dominate their portfolios, but when it comes to finding the next reliable engine of returns, commercial real estate is becoming the darling of the rich. A Kotak private banking survey, the top of the pyramid, launched in March, states that while equities continue to hold the most significant allocation among India's ultra-rich, real estate comes in second, accounting for 29% of their portfolios. Within that, commercial real estate now commands greater loyalty than residential. About 45% of respondents named commercial assets as their most preferred versus 33% who favored homes and apartments. That's an asset class that promises yields of up to 10%, compared with barely 2 to 4% from residential properties. For high net worth individuals and ultra high net worth individuals, the numbers speak for themselves, and so do the shifting regulatory winds, which have made other asset classes less compelling. The population of high net worth individuals in India, pegged at 850,000 in 2024, is expected to double by 2027, fueled by the rise of new age entrepreneurs, tech founders, and family businesses, benefiting from India's rapid economic expansion and stock market boom. Over the past few years, high net worth individuals and ultra high net worth individuals in India have sharply increased allocations to commercial real estate, embracing both direct and fund-driven models. The logic is rooted in hard numbers. Residential properties, although aspirational, rarely function as effective investment assets. Their rental yields hover at a modest 2 to 4%. Commercial real estate, by contrast, offers higher yields, and with the right tenants, location, and timing, can also deliver capital appreciation. Debt products, once considered safe bets for high net worth individuals, have been rendered unattractive by recent tax changes. Gains from debt mutual funds are now taxed at slab rates without indexation. With the new debt taxation regime, this asset class has somewhat taken a back seat. Yields are at their lowest, and after-tax returns on debt fall below 5%. Compare that with equities, taxed at 12.5% for the long-term holding or real estate, which offers both cash flow and appreciation, and the preference becomes obvious. The Indian commercial real estate landscape today is significantly broader than it was a decade ago. While office towers remain the most coveted, investors are looking at newer, more diversified opportunities. Investments into industrial and warehousing and hospitality segments stood out with sharp yearly growth of 288% and 3,810%, respectively, driven by rising e-commerce penetration and mounting tourism. Even data centers are emerging as a serious asset class, riding on the back of India's digital transformation. Co-working and flexible spaces, ESG-certified assets, and high-quality office properties are among the top choices. Tier 2 cities are also capturing high-net-worth individual attention for long-term appreciation. Environmental, social, and governance-aligned properties attract higher-quality tenants and lower vacancy rates. What makes commercial real estate attractive isn't just the headline yield of 6 to 10%. It's the stability of cash flows, thanks to longer lease tenures and built-in rental escalations. Unlike equities, which swing with market volatility, a Grade A office building leased to a blue-chip tenant offers predictability. But buying an office block or industrial shed outright isn't always feasible or desirable. That's where the alternative investment fund route comes in. The AIF model offers streamlined access and target internal rate of returns in the range of 16 to 18%, with reduced operational burden as compared to direct ownership. Typically structured as Category 2 AIFs, these funds pool investor money into a special purpose vehicle that acquires the asset. Rentals flow into the special purpose vehicle, are distributed back to the fund, and then to investors. At the end of the fund's life cycle, the asset is sold, delivering capital gains. Despite the allure of double-digit yields, investing in full commercial real estate is mainly out of reach for retail investors. The entry cost is high, the due diligence complex, and the risks nuanced. Even when smaller units are available, liquidity is limited, and management responsibilities can be overwhelming, which is why, for now, commercial real estate remains firmly in the territory of high net worth individuals and ultra high net worth individuals. The commercial real estate sector in Asia is currently at a critical juncture, experiencing significant distress due to a combination of global trade tensions, policy-driven liquidity constraints, and high vacancy rates. A prime example of this distress is Hong Kong, where the office vacancy rate stands at a substantial 17.4%, and non-performing loans among developers have reached 6.69%, highlighting the region's fragility. Institutional investors are responding to these challenges by adopting defensive strategies, focusing on sectors like logistics, life sciences, and necessity retail, while avoiding more cyclical assets such as offices. This strategic shift is driven by the ongoing debt crises and geopolitical risks that affect the real estate market. Technology-driven due diligence and opportunities for debt restructuring are providing investors with the tools to identify undervalued assets and mitigate risks within these volatile markets. For instance, Sino-Ocean's $6 billion offshore debt reduction showcases the potential for restructuring to enhance asset value. Proactive asset management, including flexible leasing arrangements and automation, is crucial for enhancing asset resilience. Additionally, secondary market transactions and general partner-led initiatives allow investors to access undervalued portfolios, leveraging operational expertise to optimize returns. In Hong Kong, the commercial real estate market's current situation exemplifies broader structural weaknesses across Asia. According to CBRE's first half 2025 report, Grade A office spaces continue to suffer from high vacancy rates, especially in non-core areas such as Kowloon East, where net absorption has hit record lows. Rents in Hong Kong have decreased by 2.8% year-to-date, and industrial leasing has stalled as global trade uncertainties deter potential occupiers. This has led to a recalibration of valuation models, with investors now prioritizing sectors with structural demand over speculative growth. The traditional valuation framework for commercial real estate is evolving, with a new focus on resilience rather than speculative growth. Investors are now looking at last-mile logistics, life sciences, and necessity retail as sectors with enduring demand, while steering clear of office spaces and discretionary retail. Logistics demand remains strong in regions like Australia and Japan, buoyed by the rise of e-commerce, whereas Hong Kong's industrial sector continues to lag, with warehouse vacancy rates climbing to 10.3%. This divergence in performance is leading investors to reassess their strategies and focus on sectors with robust demand. For institutional investors, the key to navigating this challenging environment lies in thorough due diligence and proactive asset management. This includes diversifying sectors and adopting defensive positions, which have become essential strategies for mitigating risks and capitalizing on potential opportunities. Debt restructuring and distressed asset opportunities are increasingly attracting the attention of investors. The debt crisis among developers has created a pipeline of distressed assets ripe for acquisition and restructuring, providing a path to value creation through enhanced operational strategies. Advanced analytics and artificial intelligence tools are playing a crucial role in due diligence processes, enabling investors to assess undervalued assets more effectively. Platforms that aggregate data on logistics, demand, and supply dynamics are helping investors identify promising opportunities in constrained markets like Hong Kong. Ultimately, the commercial real estate sector in Asia is undergoing a transformation, driven by weak fundamentals and regional risks. Institutional investors must adopt a disciplined approach to due diligence, leverage technology, and prioritize defensive sectors to navigate the downturn and position themselves for future gains. In a significant move for the commercial real estate sector in Saudi Arabia, Al Khazama Investment Company, a leading developer and manager of luxury commercial properties in the kingdom, has partnered with Yardi to manage its extensive portfolio. This includes the iconic Al Faisaliya Tower, a prominent 267-meter-high commercial skyscraper and mixed-use complex located in Riyadh. This strategic collaboration is set to optimize the management of Al Khazama's properties by integrating Yardi's commercial suite of products. These advanced tools are designed to streamline financial operations, enhance operational efficiency, and improve transparency. The platform's lease management capabilities will simplify the administration of commercial lease agreements, ensuring accuracy and efficiency. In addition to lease management, the partnership will leverage Yardi's integrated deal management and advanced forecasting software. This will empower Al-Khuzama to make data-driven decisions, enhancing its strategic planning capabilities. The move aligns with Saudi Vision 2030, reflecting Al-Khuzama's commitment to adopting smart real estate solutions that support the kingdom's digital transformation goals. A representative for Al-Khuzama Investment commented on the partnership, stating, "By adopting Yardi's advanced commercial solutions, we at Al-Khuzama reaffirm our commitment to innovation and operational excellence. This collaboration will drive greater transparency, optimize asset performance, and set new standards for property management in Saudi Arabia and the region," said Haider, Senior Director for Yardi, expressed excitement about the partnership, noting that Al-Khuzama's adoption of Yardi's technology will enhance operational transparency, improve tenant satisfaction, and drive long-term growth. This collaboration is expected to transform Al-Khuzama's commercial management offerings in the Kingdom of Saudi Arabia. Al-Khuzama has been a key player in shaping the kingdom's luxury hospitality and commercial landscape since 1995, with a portfolio that includes landmark hotels, high-end retail, and premium office spaces across major Saudi cities. Today, the company ranks among the top 100 companies in Saudi Arabia, driven by a clear vision and a deep understanding of the market it helped define. Yardi, known for its industry-leading investment and property management software, is working globally to drive significant innovation in the real estate industry. With over 9,500 employees, Yardi continues to support clients worldwide, providing end-to-end property solutions that streamline and enhance commercial operations. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoon. See you on the next one.